Things are not always perfect, never perfect actually in the business world. And so let's take the information that we have, take the mental models that we've built over the years and just make calls and move forward, and let's get on with it. Let's try and solve the problem. It's always a point in time, right? It might seem like it's most stressful, it's terrible today, etc. And then you look 3 months down the track and things are completely different in the business and you've managed to live to fight another day. And it happens, but it happens across all the businesses. So it's not an easy journey being a founder and having to figure all these things out.
Hi everyone, I'm your host Rohit Bhargava, and you are listening to episode 191 of the Startup Playbook podcast, a weekly series where I sit down with successful tech founders, investors, and operators to unpack their journey lessons and insights to help current and future entrepreneurs. The voice that you heard a little bit earlier was that of our guest for this episode, Stew Glynn. Stew started his investing career after joining Shark Tank's Steve Baxter in building out his family office transition level investments. In 2019, they then launched Ten13 VC, where he is the co-founder and managing partner. Ten13 is a global deal-by-deal venture capital firm that has invested over $100 million across 80 portfolio companies. In this episode, we covered a wide range of topics, including how his childhood experiences in Zimbabwe shaped his view towards risk in business, the pros and cons of the deal-by-deal investment model, Ten13's approach to network-based investing, lessons from investing over $100 million across 80 portfolio companies, and much more. Without further ado, here is my interview with Stew Glynn. Hi Stew, welcome to the Startup Playbook podcast, and thanks so much for taking the time to be on the show today.
Fantastic to be here, Rohit. I've seen so many great folks on the pod over the years and great folks from the community. So it's awesome to be online and looking forward to diving into it.
Yeah, likewise. I know we've been speaking about doing this for a while, so glad we can finally make this happen. But Stu, for those people that may not be as familiar with your background, do you want to share a little bit about your story and what got you here today?
Sure. So I currently live in Brisbane in Australia. I'm the co-founder and managing partner at Ten13. So we're an early stage venture firm that's got a little bit of a different background. We call it network-based investing, but effectively we've built one of Australia's larger groups of angel investors and family offices that are looking to support the next generation of great companies coming out of Australia and wider. And we set up the firm about 4 or so years ago, but before that, I used to manage Steve Baxter's family office for transition level investments. And prior to that, for my sins, had a more corporate career in strategy and finance at KPMG and General Electric or GE. But I originally grew up in Zimbabwe and had an amazing childhood over there in Africa, and then moved over to Australia and I guess fell in love with the country. It's been very good and prosperous for me, and I've loved being part of it, of the community here. So I stayed and married an Australian girl and have a couple of kids now, and yeah, it's been an awesome ride being part of the technology rise in across Australia over the last decade.
Yeah, and I think it's always, as you mentioned, really fascinating hearing people's background and really how that shapes what they go on to do with their career, but also specifically how in this space it shapes how they look at opportunities and those sorts of things as well. From what I understand, your dad was a bit of an entrepreneur himself and had several businesses, mainly one in tourism as well.
Yeah, that's right. So yeah, my dad's been like a great role model for me over the years, and particularly around building business in a place like Zimbabwe. It's a very entrepreneurial environment over there. There's no sort of safety net. Basically, people are entrepreneurs whether they like it or not, and whether that's from selling tomatoes on the side of the road at a market stall all the way through to sort of building larger businesses. And so my dad had a handful of businesses. He went back to support his father when he finished university in a nuts and bolts like hardware business. They had 7 or 8 employees at that point, and he grew that business to over 200 employees, and they were servicing all of the, I guess, farmers all around the whole of Zimbabwe with all of their hardware, nuts and bolts, etc. So arguably like the Bunnings style product in Zimbabwe. That business was challenged because, well, I guess like over time they were importing a lot of goods. The Zimbabwean currency started to see issues and effectively had to continue to try and build out the business. They ended up selling that business, and my dad moved into a tourism business. So he started a trading business around booking of hotel nights before the internet was even around. And then post that went and built a handful of resorts and beautiful places around, not only in Zimbabwe, but built resorts in Mozambique, in Zambia, and Botswana. And so over the years has been heavily involved in the tourism and wider safari industry. And it's obviously an amazing part of the world. There's wonderful wildlife, and been a massive advocate for conservation, etc. But just been amazing to see someone, I guess, not with no experience, decide one day, hey, I would like to build a hotel here, find an amazing spot of land, and now it's like an iconic lodge in Victoria Falls in Zimbabwe, which is one of the wonders of the world. And I think they just had their 30th reunion, sort of like sort of anniversary. But yeah, super. I remember being there when I was 5 or 6 years old, and they were breaking ground and trying to build their first foray into tourism, and yeah, but it's just amazing to see what can be done. And I think that was like the beginning of my understanding of what a founder's journey looks like, and that you swing the bat at different types of businesses, and it's not always a smooth ride, particularly given the environment in Zimbabwe. There's definitely been like an interesting sort of turbulent part of the journey around Zimbabwe, and there's a lot of I grew up with a lot of political strife and economic sort of turmoil around Zimbabwe. They had the Mugabe presidential era. He was the president for 33 years. Had a really good, positive period when they took over from independence, and then a not so positive period where there was hyperinflation and a bunch of things like that. And so got to live through all of that and see how business decisions got made, and how my dad tried to navigate and build businesses and rely on the community to make decisions. And it's just been really insightful for me, and gave me a lot of early understanding about what it takes to go and be a founder and build a business, right? And the roller coaster ride that you sign up for when you go and try to do that. And I think that has largely influenced me in terms of my career path and where I've wanted to go and spend my time, and supporting founders and being part of that journey, and even setting up, arguably, it sounds odd that a venture firm looks at ourselves as a business, but I feel like we are ourselves like a startup, and we're trying to build a brand and a different business model around attracting investors. And I think a lot of that comes from like your upbringing and learning, like the background of what it takes to build an exciting business.
Yeah, absolutely. I also have heard that your grandfather was a bit of a role model for you as well. From what I understand, he was a school headmaster, and I think you've said he was very values driven. And I think I heard a story about where 1,000 people showed up to his funeral. How, like, you've obviously kind of spoken about how that sort of experience with your dad helped you think about businesses and those sort of things. But I guess how have some of those experiences of growing up in Zimbabwe at that sort of interesting time period, as well as your family experience and upbringing, shaped how you think about just operating businesses, or like the values that you instill in founders that you look for, or just how you operate businesses?
Yeah, I mean, I'll probably like break that into sort of two parts. Like, I guess the first part being my grandfather. So he was not entrepreneurial by nature, but he was hugely influential in the community. So this is in a place called Bulawayo, which is like the second largest city in Zimbabwe. My grandfather was a guy called Neil Todd. He passed away a few years ago, sadly, but had a very probably 50-year plus career in education in Zimbabwe. He was originally at a boarding school called Plumtree as a teacher for 20 plus years, and then he became the headmaster of one of the largest all-boy private boarding schools called Falcon College. So he influenced a lot of lives along the way, and he was universally well regarded and loved in the community. And I think he just showed the right moral fiber and ethics on how to and effectively was massively influential on a lot of people that came out that went through the school by putting in place the right frameworks and pillars and structures to effectively, I guess, build good people, right, and educate them on the way of life and how to interact and how to have the right ethics, etc. And so he was a very humble man, but also very, I guess, stern and firm with the way that you're dealing with 500 plus all boys school. Like you do have to make sure that there's a mix of discipline and engagement. But so it was really interesting, and the way that it influenced us as a family, as I didn't actually go to that school because of my own grandfather. I guess there was a conflict there, but we got to spend most Easters and Christmas at the school and run around there. They had a game park next door called Quiet Waters, and we got to, with all of our cousins, spend a lot of time as a family. And so we'd often have, and I think that has resonated with me. I truly value family. I think it's a very important part of life, and so not only for my own children, but really I've got 3 sisters, and believe heavily in I guess doing what you need to do to make sure that your family is close and engaged and you have positive relationships, etc. And I think that all stemmed from a very close-knit group of, I guess, our family that would see each other very often. And so they were hugely influential in our lives. And as you mentioned here, when he passed away, they couldn't fit, I guess, people even into the church, and it was sprawling out into the car park and the street, because he had such a large influence. And you can see how figures like that can actually impact a lot of people's lives, both directly and indirectly. This goes to, I guess, a view set of like how you build your own business and how you interact your own life with and what you value around family and not only family but also I guess how like it's sort of a good framework for how you operate life. And so he was an amazing man. And so like I took a lot of that, I guess, into the way I try and live my life and break them into different areas of family, business, friendships, things of that nature, community. And so how do you make sure that in the world that we live in, which is fast paced, you're juggling a lot of these things, trying to make sure that you have the right balance in life. And so, yeah, I mean, hugely influential. And then on the sort of wider question of Zimbabwe, I think, look, it was an interesting place to grow up. Like, I effectively had economic collapse in the early 2000s. The Zimbabwe dollar at one point in time was a stronger currency than the US dollar, even close to the pound. And I guess there was a point in time when it had over 1,000,000% inflation. I think it's the largest inflation on record. So what that would mean in practice is, you think we're talking about sub 10% inflation here in Australia at the moment. It's obviously been improving, but this is where you basically revalue your goods twice a day. You literally go around with stickers and will reprice and basically double your prices. My father had, say, a couple hundred staff that worked at the hotel called Big Falls Safari Lodge. They had to literally import goods from different countries, set up their own effectively grocery store and pay people in coupons or like effectively barter currency, so that they can afford, because if you paid them in cash, it would be worth like not enough. It would like within one day, the value would basically evaporate. So this was a way you basically started paying staff in coupons, where you could basically go down and get at least your staples from the grocery store, and then on a Friday afternoon, you'd basically, hey, here's your cash component of pay, and you get it on Friday afternoon, and you'd be able to basically go down to the pub and have a beer and a meal, and that would probably be or buy whatever else you wanted to, but it would be devalued already by the following week. And so I think my dad, he's got he claims to be the richest person on earth, because he's got, I think at one point they had $100 trillion notes. So when they were going to they basically, I can't remember the exact date, but they canceled the currency and they basically made it a US dollar sort of current, I guess, economy, and went to a friend at the bank and got 1,000 of these notes. And so in his I guess at home, he's got like 1,000 wrapped notes that are $100 trillion notes. So claims it's like the but I think it's like people, the interesting thing was that, like, despite it being there's a huge amount of challenge, people they were very happy people, despite facing a lot of pressure, a lot of issues around political and racial issues, economic, kind of it's borderline impossible to operate in that environment. I'll give you an example, like the tourism business. There was points in time where if you were earning foreign currency, so a lot of people were traveling to Victoria Falls, you would earn in US dollars, you'd have to put 50% of those of that revenue into the bank at the bank rate, which was less than 1,000 to 1 of the real black market rate. So you would basically write off 50% of revenue as a cost of goods sold day one, before you even could start to look to pay staff and do marketing and run your business. And so these sort of challenges, it showed like sort of innovation, but also showed like what it means to be entrepreneurs, to be able to navigate through challenging environments. And so the instability around the growing up in the country was really interesting. And that I guess by necessity bred creativity, and people solved problems, and they did what they needed to do to keep their businesses operating, etc. And so the innovation was crazy around just what people had to do just to run day-to-day businesses and keep paying. So yeah, it was really interesting. But I think that is when you come to a place like Australia, where there's rule of law and prosperity, and it's effectively it's a much safer environment. Everyone has the ability to access education and healthcare effectively paid for by the government, or not government, by obviously taxpayers, but you've got amazing kind of infrastructure here. So it's not the same. People don't have the same opportunity in places like Zimbabwe and many others, but I guess that safety sometimes can also go the other way, where effectively you don't, where it's almost too safe. So there's a fine line between the balance between how do you make sure people are being the most creative and are happy to take the risk to go on like this sort of journey of being an entrepreneur, etc.
Yeah, no, I can imagine. I spoke to Alex Zatarain from Eat Sleep, who spoke about not maybe in the same kind of context from hyperinflation, but in terms of the challenges of growing up in Mexico and how that shaped her views on life and risk. Someone I spoke to who's been on this podcast before, Holly Cardew from Carded, one of the things that she mentioned is your superpower as an investor is how you just don't seem to be stressed at all in situations compared to a lot of other people that she's spoken to. Do you think that sort of early exposure to such a volatile or like ever-changing environment that forces innovation, forces you to think on your feet and problem solve in those sort of situations has really shaped how you think about sort of investing and approach life?
Yeah. I mean, the short answer is I think it's totally impacted my mindset and risk appetite. I feel like sometimes that's not always a good thing, because I always think there's a way out, and I think we can break through. And so, like a typical kind of, I guess, entrepreneur, I have a high level of optimism and think that we're gonna be able to find a way. And I think that totally. I think it comes back to potentially risk profile and what we've seen people be able to navigate through over time. I think not only in childhood, but longer and wider over time. And then also once you start to spend a lot, we've invested in a lot of different companies, and you get to see under the hood of companies, and you get to see that even on a very successful business that goes on and gets acquired, like how many times that business got close to bankruptcy or very close to the edge. And it's just, there's no linear line in this world that we live in. It doesn't matter, and problems will always be there. In fact, problems are a good thing. It means you're making progress, and as long as you're making decisions and moving forward and not being stagnant and indecisive, I think that you just need to navigate and play the cards that are dealt. And obviously, over time, you get a lot of learnings, you get a lot of instilled kind of knowledge around how to improve or make better decisions and use those sort of mental models going forward. But at a high level, I think, and this probably is bifurcated, I would say, like, my wife would probably say the opposite in terms of like my dealing with toddlers at home. My kids are 5 and 3, and I think it's so funny how your stress level can go way higher. And I'm like, I try and break this down. I can't really understand why at work you'll be dealing with a massive fire with one of the portfolio companies and trying to help them problem solve, and it's life or death for that business, and you're firefighting, trying to support, but not be materially stressed that you can't even move, and then sitting at home you've got like your 3-year-old child being a three-nager and not listening to anything you say, and you kind of like, it's like, anyway, I personally get higher stress levels from that than from dealing with just typical sort of business problems and problem solving. But yeah, I think it's an interesting. I have a question that myself of like, why do I guess like I'm relatively placid majority of the time. Like I don't get massive emotion around it, but I just think that you have to put problems into context and get to solving them, because effectively there's no point in getting emotional about things that haven't gone right, and things are not always perfect, never perfect actually in the business world. And so it's just, hey, let's take the information that we have, take the mental models that we built over the years, and just make calls and move forward, and let's get on with it. Let's try and solve the problem. And I think if you do that and you're taking steps forward, then they work themselves out. And I've just seen it happen, and particularly, over the years of being involved with a lot of different businesses, it's always a point in time, right? It might seem like it's the most stressful, it's terrible today, etc. And then you look 3 months down the track and things are completely different in the business, and you've managed to live to fight another day. And this it happens, but it happens across all the businesses. So it's not an easy journey being a founder and having to figure all these things out. But I think also what people are trying to do is create things that haven't existed before, and so there is high level of risk in it, and it doesn't always work out. And so you have to understand that too.
Yeah. I think, as you said, part of the benefit might be some of the environment that you grew up in and being exposed to that. I think one of the other benefits is probably seeing, as you said, like a cross section of different businesses and understanding that it's a common situation. Seeing people overcome some of those obstacles time and time again builds up that muscle in a way. One of the best bits of advice that I ever got was from a former partner at a former business, Adir Schiffman, who came from a medical background and said, no one's died, and really helped put things into context. As you mentioned, for founders, a lot of the time, a lot of these situations can seem like life or death because they're in that moment and really feeling it head on. Do you have any advice or anything that's worked with portfolio companies, aside from just being there and talking through them with things? But I guess any advice for founders who are maybe going through a difficult period in terms of how to be able to put those things in context, or how to be able to overcome some of those challenging times?
Yeah. Look, I mean, I think it's like pretty challenging times right now. If you look at like the tech industry and the progression between different funding rounds to be able to actually raise money and keep going on the journey. And so it's not easy. But I think the way that I think about this is just you've got to, it's about distance traveled and staying the course, and just it's generally comes back, in my opinion, to grit and resilience. Are you happy to, it's a painful journey, but oftentimes when businesses fail or things don't work out not every occasion, but I would say a majority of the ones that we've seen is when the founders give up or they're burnt out and the energy is done. That is when there's no sort of path forward, if you know what I mean. And so don't let it get to that stage. So if it's seeking help, or if it's leaning on mentors, engaging with folks, like helping them solve your problem, because like most things can be solved, but if you don't have the right mindset, if you're not in the right space, if you're burnt out and you're being at it and you've pivoted the business multiple times and you've got running out of runway and you've got all of these walls in front of you, it's hard to see the forest for the trees, right? And so oftentimes it's like, how do you make sure you don't get into that scenario? So is it keeping healthy? Is it making sure you've got people you can lean on, whether they're advisors or non-conflicted folks who have found a community and things like that? But look, I think at the end of the day, it's just not an easy journey, and that's why it's not for everybody. Like people, like entrepreneurship is a tough road. You're signing, particularly in a place like Australia, where you could have a great life not going down that road. You could effectively go and study, go work in a large corporate, have a great career, earn great money, and not have to take any of this risk, right? But often entrepreneurs are built differently. They don't see it like that. It's something that they want to do and they need to do, and they're happy to go on that journey. But even that said, like everyone gets affected, and it's not because of all the challenges in front of you. It can weigh down on you. So how do I not get stressed? I try and do things like make sure you're consistently exercising, make sure you're keeping yourself in check, and talking to the right people, to whether that's your partner or my wife, etc. And just like making sure you do the things that can look after you, so that you're at 100%, so that when the inevitable problems arise, you can go and solve for them. And I think that is probably the case also with a lot of founders. It's just there's no perfect art to it. You've got to do what works for you. But at the end of the day, it's working hard on how do you actually get out and do it and make decisions and be operating at the right tempo, because there's going to be problems forever. I love the book Shoe Dog. It's probably my favorite business book, with another story of Nike by Phil Knight. But he doesn't even step it out in terms of, I guess, phases or anything. He literally just puts, this is what happened in this year, this is what happens in this year. And he just literally goes every year up until IPO. And they've had problems since IPO soon. I think even at the moment they're in challenge territory. But it's every time it's like, this company almost collapsed because of this, or some IP issue, or they couldn't finance the company, or whatever it was. But it happens. This is part of business. And so it's just like, it's as long as you're in the game, and you're, it's half the battle is staying in the game, I think.
Yeah, and it's the interesting kind of counterbalance to that, because I totally agree with part of the challenges. You don't want to, the first time you see a difficult time period, you don't want to give up. But there are also instances where founders are maybe working on the wrong thing, and being able to make the judgment call to say, this isn't the right thing, we need to move on to something else, is also equally important. I was speaking to Arn, who is one of the other partners at Ten13, and he mentioned, I believe it was Go1, the founders had a previous business, which I believe Transition Level Investments might have invested in, that didn't work out. And then obviously that sort of led them into doing Go1 as well. So again, I guess from your perspective, both maybe in terms of, I guess from a founder's perspective, it can seem really difficult. As we said, you don't have that perspective. And so it can feel like the end of the world if what you're working on isn't quite working and you do have to make the call that it's not the right thing. But maybe even just using that as an example, do you want to share a little bit about how you thought about the perspective of, from investor perspective of backing the founders again, even after a business that hadn't quite worked?
Yeah. And just to put some framework around like the commentary around staying in the game, that doesn't necessarily mean you just have to go forever on the one idea, because honestly, most companies change form, they change direction so many times. But like my point is probably staying alive so that opportunity can come to you, if that makes sense. So for instance, a good example is Clipchamp, right? Clipchamp is a online video editing tool based here in Brisbane. There were 4 guys ex-SAP. They raised a small amount of money for their original business plan. I think they pitched the family office with Steve 2 or 3 times before we actually invested, and they pivoted the business 3 times into completely different businesses. Like it wasn't even related; it was same company, different business completely. And the third time when we saw it, I had started at transition level with Steve, and they had launched a lightweight online video editing app. And they just had this on the wall. They had big glass. It was in like co-working space. They had this big office, or not a big office, but they had an office that had big glass walls. And on one of the walls, it just was projecting their user count and where people were signing up all around the world. And we first thought it was like 5,000, and then it was like 50,000. And the next time I was in, it was a few 100,000. And we're like, it's doing something right. Let's go. Let's obviously engage and figure out where they're at. They'd obviously pitched us different businesses. The same Clipchamp was the same name, different business. And then, they came to us and we had more of a chat and loved what they were working on and thought video was going to be really interesting as a category. And that business now, they raised us, like we led their like a post-seed round. I think we joined the board. Steve joined the board. I was an observer, and we helped them raise a Series A from Tola, which is a Seattle-based VC. And then they grew to about 15 million users around the world, product-led growth, great story. And then they were acquired by Microsoft for a great result for the founders, investors, etc. But now Alex is running a business. He's still there. They've got 90-something% staff retention, still based in Brisbane. He reports into the CEO of Microsoft Office and is in one of the top 100 employees in Microsoft, one of the biggest businesses in the world. And their distribution is amazing. Like they're effectively like right next to PowerPoint and Excel. But it's like shows what is possible, right? Like they started the business with a completely different plan, but those 4 founders stuck together. They decided, hey, this wasn't working. Let's go this direction, and then again this direction, and even then, trying to raise we tried to pitch to a bunch of investors. We tried to help them and introduce them to a bunch of investors around Australia because we didn't have that much firepower or capacity from a venture, and average check size from the family office was like 250 to 500K. We tried to help them raise a seed round of seed Series A. In those days, it was probably closer to Series A. They're trying to raise 5 million. Anyway, we couldn't get it done. The founders tried, talked to all the firms. People didn't align with it, didn't see the value or didn't see the vision, and we eventually were like, look, we love what they were working on. So we actually invested close to $1 million through the family office, which was one of our biggest checks, and actually I tried to lead it and brought on a couple of other investors and angels, gave them enough to get to Series A and launch their proper product. But it's not easy, right? Like even you look at it now and it goes, oh, like it was evident. It's evident now that video is for business is going to be a thing, and they've obviously got distribution through Microsoft, and it's the biggest platform for marketing to business in the world, and they got amazing usage. But that wasn't the case when you're looking at it from an investment perspective, and so. But yeah, anyway, so that's I guess a story of and that same thing happened with Go1. They had a great consulting business in the space. They were in the millions of revenue, and they literally turned it off to go and productize and build the Spotify for corporate education. They went through YC, but they effectively said, we're shutting this down. All the staff that we were paying, we're bringing it across, and we're just going to productize here, and we're going to try and build a scalable business. And so they shut down a whole bunch of that revenue to go after building a business that they thought had better scalability. But they learned what their customers wanted, and they saw the opportunities off the back of that original development house agency business, right? And so I think it's probably piecing together the information, and it's not always clear, right? So you it takes time to will it into existence, but even then, just to form clarity of like what it is, even that you're building and what's going to resonate with customers. It's never a straight shot, and it's doesn't happen very often, from our opinion, that you get first product, first go to market, and you just launch and it goes so well. Like every company generally that we see has 3 cracks at trying to launch product, find the right way to sell, engage with the customers, get the right value. You've got to iterate, you've got to keep evolving the product offering over time. So yeah, like it's all part of it though, right? It's like if you have the right, in my opinion, if you have the right mindset and take on the feedback from customers, from the ecosystem, etc., then you can form the view. And oftentimes, like your view, like you as an entrepreneur is trying to understand, see the future, and try and build for that, right? So it's a difficult job.
Yeah. I mean, another example, as you mentioned, that was Holly, when she initially raised the capital from Ten13 and others, it was for VOP.
Yeah.
And then I believe 3 months after she fundraised, she had a meeting with you and said, yeah, we're, completely pivoting the business. And you was on board. And as you said, in your experience, it takes companies in general 3 cracks, especially at the very early stages, to really find product market fit or find their straps with things. What are some of the ingredients then that knowing that and working backwards, what are some of the things that you think founders need to be successful in giving themselves the time necessary to figure that out? Is that having enough capital in the bank? Is that just speed of execution? Like what are things that you look for or things that are important for you, knowing, especially if you're investing in companies at the very early stages, to make sure that they have enough times and iterations to go through those 3 cycles?
I think a concept that a thread that I like to pull on is a concept of distance traveled. And so effectively this is what traits has this person or founder shown historically that has sort of led them to this point, but also shows the way that they operate, and either the speed of execution. Even if they're young founders, it's like they can often show evidence of past track record or things that they've done that are not the normal sort of path and safe path that you would see. So what's an example? Someone like Liam Millward started a company called Instant. He raised a seed round when he was just turned 18, but when he set up the company, he wasn't old enough to even register the company. He had to get his I believe his mother or one of his parents to register the company. But before that, had built a travel following on social media and blog from memory, and had like a lot of, and was building profile, like something that you would not see a 16-year-old or 17-year-old do. And then Liam, we took part in their pre-seed round, and then they did a seed round, and now Liam, I think his 21st is coming up now, growing exceptionally fast. But even then, have iterated on the business, and they had an online checkout product that was like one-click checkout. They're riffing on the Amazon sort of style offering, but now they've launched a new product called Audiences, and they're effectively think that Audiences is resonating even more, so they're growing that, they're pushing on that and using that as their primary sort of sell. And so even then, from the starting point, it was like, I want to do one-click checkout. But even thing that was interesting is that there was a couple of other companies that were high profile. One in particular that was like a high profile failure in the space and could be viewed as a tainted category. But the founders were hungry, keen to have a crack, and were keen to move fast, and didn't see that as a deterrent, and it's working for them. So I think oftentimes it's when you're unpacking, you're generally backing the team and the founders or the founding team in that first pre-seed and seed check. And so, and in my view, you're almost always backing the founders. It doesn't matter what stage, but are they the right people to go and execute on the plan, and are they leveling up? But how do you find we spend a bunch of time when we're talking to those initial chats, like who are they, what are their backgrounds, what makes them well positioned to go after this, why are they passionate about it? Do you think that they're reasonably happy to subscribe to the long and tough journey ahead, and are willing to go the distance? And so that's a lot of the read that you try and build up over time of all these people. Are they hungry, and do they want it? What's driving them as a force? And so, and look, there's no perfect science to that. In short, there's so many different inputs, and founders come from so many diverse backgrounds. Some are from corporates or scale-ups and have seen the opportunity, and they're spinning out of Atlassian or Canva and have been part of that growth trajectory. Others are from more traditional businesses, and they've basically have great industry experience, but I think that there's like an opportunity within there to go and build software products, etc. So look, I don't think there's there's no secret sauce to it, in short, but it's over time you start to recognize things that have gone well for the type of folks that you've supported. And honestly, we make some great decisions as investors and some decisions that don't work out, and that's part of the world that we live in. We're investing at fledgling early stage companies and trying to support them from the earliest days, but it's not everything works out, but if oftentimes, and that's okay also. I think the other thing is that like people, I don't like the fact that Australia can be criticized oftentimes about tall poppy syndrome and folks that go out and have a crack at doing something ambitious, and then if they fail, it's a sort of doomsday. It's like it's not good to lose money. We are conduits of capital as investors. You want to invest in prosperous businesses, but the truth of investing in venture capital is that half companies won't work out in the way that you'd hope, and founders, they take that risk. They want to go and build something, and they take on the capital to go do it. But it is what it is. It's not it shouldn't be sort of demonized on the fact that it's not successful. You should actually be applauded, and then off the back of that, those founders have got a lot of experience that can be very valuable for if it's the next company that they want to go and do, or the next or whatever they go on to. But like, you learn so much being in the driver's seat. So yeah, I mean, it's part of the nature of early stage being a founder and early stage investing that's sometimes happen.
We're going to take a very quick break from this podcast to talk about an important issue, which is the growth of your business. Specifically, how long sales cycles when selling to large enterprise customers can slow down progress for so many startups. Unfortunately, a portion of this is out of your control, but something you can do to accelerate your sales cycles and sell to bigger customers is to demonstrate your security compliance with standards like ISO 27001 or SOC 2. The problem is that achieving compliance can be a big distraction and a large financial and operational drain for your company. Thankfully, our partners for the show, Vanta, can help with this. Vanta automates up to 90% of compliance, getting you audit ready quickly and saving you up to 85% of associated costs. And Vanta scales with your business, helping you continuously monitor compliance, unify risk management, and streamline security reviews. There are over 7,000 fast-growing companies like Atlassian and Dovetail that use Vanta to build trust and prove security in real time. They've been supporters of the show for a while now and are doubling down in their support for our community by offering $1,000 US off their plans. To access this exclusive offer, head over to vanta.com/playbook. That's VANTA.com/playbook. All right, let's get back to this episode. No, absolutely. And I think speaking of that journey, I think even 1013 we've built is incredible, but even getting the journey to that particular point is super fascinating. Even maybe going back to, I believe you first met Steve at a startup weekend competition.
Yeah.
We used to pitch a startup, and from what I hear, he really laid into you in his particular style.
Yeah, in typical Steve style. Yeah, we had I remember it quite distinctly, actually. This was probably, it's 10 years ago. I was working at KPMG in their M&A team. So I was helping private businesses raise either venture capital. We worked with a couple of tech companies and helped them raise VC, but also worked with private companies looking to sell to either trade players or private equity. So more traditional sort of space, but saw an opportunity in tech, and so I was spending much time in the ecosystem. Steve was very influential in the Queensland tech ecosystem, helped build River City Labs, had an accelerator called RCL Accelerator. And I guess that was the hub of where I guess there was activity a decade ago in Brisbane. And so, I pitched at a startup weekend. I recall it was called Vouch Potato. It was effectively, we came up with a concept that if consultants or freelancers could get other businesses to vouch for them and give them like recommendations that would be helpful for selling and growing. But anyway, it was like came up with it on the weekend and tested it with a few people and etc. But got torn down for a variety of reasons by Steve and the judges. But anyway, that was that's just pretty standard stuff. It was a bit of fun. But I managed to sort of connect with Steve, and then he was looking to build out his family office. He had built and sold. His last business was Pipe Networks with Bevan Slattery, which was acquired by TPG, they were listed on the ASX. So had been founder all the way through to listing, etc. But then Steve had started investing in early stage tech and wanted someone who had more of a finance background from a deal perspective. And so I basically chatted to Steve. I was also running like a small e-commerce business on the side of working 12-hour days at in my M&A job, but it was the early days of influencers, and I was trying to build a direct consumer kind of e-commerce business. And Steve was on Shark Tank at the time. And so, look, there was a lot of overlap there. So when we connected, he was like, look, you understand the deal space. You're obviously interested in technology. You're trying to build your own sort of e-com business. We need someone to help me do due diligence on Shark Tank deals, as well as execute on an area that we were more interested in, which is more like just direct investing in seed stage companies. And yeah, managed to invest in some so joined up to manage the family office for Steve for 3 or 4 years, build out a bit of a team and a brand. And I guess like we learned a lot of things over that time. We had some great results. We had 7 or 8 exits from that early portfolio. The likes of Clipchamp was acquired by Microsoft, but also had Car Next Door, which is on Shark Tank, was acquired by Uber. We had a company called Dose Me, which is dosing of dangerous drugs, that was acquired by Tabula Rasa, like a US-listed healthcare company. And so started to refine how we look at companies and what's successful for us and work for us. And then we started, okay, what looks next? I had a lot of energy. I was like, let's go and build something. And so we started riffing on what Ten13 could be and what could be a differentiated model to your typical seed stage VC, which we could have gone down that path, but we decided on a different sort of model, and that was the genesis of Ten13. So yeah, it's been good.
Yeah, as you said, there was a more traditional pathway that generally happens in terms of like raising a more traditional fund. What was the genesis, or what was the catalyst for deciding to go down the more syndicate, community-based investing structure that Ten13 is?
Yeah, we looked at it from 2 angles, but to give everyone like an overview, Ten13, effectively, we operate like a venture firm when we go and talk to founders. So we effectively are like we're seed stage investors generally, but we invest from pre-seed onwards. But we don't have your typical fund structure. We basically raise money on a deal-by-deal basis, and different investors from within our community chip in and syndicate or co-invest. We call it co-investment. Co-invest with us, and we pull all of that capital together and then invest that through one entity into each company. So look, when we first started, we said, do we actually want to raise a fund? We had some track record. We were building some ability to do so. But also, like, we wanted to... Steve particularly had done a lot of work in the community in Queensland around technology and getting more entrepreneurs to go and build businesses. But we also found there was quite a large gap in terms of angel investors and bringing people that had traditional wealth from property or mining and corporate executives. And saying, these people have great experience. They have capital to deploy, but they don't understand technology as a category. So could we bridge that gap and and educate those folks, but give them the opportunities? They're often time poor. It would be nice to do, but if they're not brought on the journey and they don't understand what can happen with these businesses and what the opportunity set is and how important it is for Australia. So we took is there an education angle that could be helpful in a community where we can basically engage them for events as part of the Ten13 community and just try and educate on the market, and at the same time package up deals that we think are investable, that Steve is also investing in through the family office. So there's good alignment, and share those out to people, and they could pick and choose the ones, but also they can get educated on, hey, these are new business models that are emerging. These are new technologies. These are interesting opportunities coming through the funnel. Because can we peel back the layer of what decision making looks like in venture capital and get more people excited about the category? Because I personally am a believer that it's the future, and it's and technology impacts all of us and all of our lives across the board. And so we think great businesses can be built from Australia and wider. And so we want to be part of that. But so it's like, how do we attract more people? And then the other part of the model, though, which I think is pretty unique, is that you can use this to your benefit. We call it network-based investing, but effectively there's a couple of aspects to it. Like one, we have a scout program, so every one of our investors can bring a deal to us, and because we have a deal-by-deal nature, we can incentivize them to bring deals to us. So there's folks in our network who, for instance, one of our favorite investors recently shared a deal that is going to their Series A. Great company. He's got a great relationship. He's on the board, and we probably would not have seen this deal otherwise. And he was like, look, I'm already an investor, really love this company. It's a rocket ship. Come have a look. But also can say that we've been good investors to work with to those founders. And so we get proprietary sourcing, so we don't have to have that, and that can come from a variety of reasons or angles. We've got a large network, well over 500 investors around Australia and New Zealand, and we try and map who they are and their backgrounds, and so we can do due diligence on a company. Like, we're agnostic on sector, but we try and use that to understand if it's in biotech or if it's in whatever, really, mining, whatever category, education. Like, we effectively have 10 people on the call list straight away that we can tap into, and we leverage that aggressively, trying to understand and not get up to speed on basically each industry, because you can have mental models around each kind of business model and things of that nature, but whether it's the right timing for the industry and the opportunity, that's quite challenging, and you generally want to talk to subject matter experts or industry people to get a steer. And so we leverage it for due diligence. But then the thing that's probably the most important is then how do we share our deals to those investors, and then say 50 of them decide they want to invest and co-invest with us in a deal. Then we've also got a program called Radar, where those people, if they want to, they can opt in. And if they opt in effectively, then whenever we share the underlying investor list and all their backgrounds to the founders, and they can say, hey, I would love to connect with X person about this concept, or every investor update that we get from them, we really call like founders to call out asks like, hey, I really want some help on structuring KPIs and how do I do that, or I really want some help on like US go to market and how do we do that. And we put that ask in, and effectively then any one of those underlying investors can put their hand up and say, hey, I've got the experience here, I can help you. And so it's basically like a knowledge base. It's one-to-one. You don't have to go and get 50 angels on your cap table and do 100 coffees to try and get those people to be aligned. Like they've seen a deal memo, they love your business, they've decided to put their own personal capital into the business, they want to see it succeed. And if they can help with a bit of their own experience or network or introductions to customers, then how do we amplify us? Because the problem with venture is it doesn't scale, but you have a large portfolio. So you have to invest wide. You can't just concentrate like private equity. But then so we were like, okay, well then you get bogged down pretty quickly because of the size of your portfolio. But if we can help engage the network of folks that can bring value and help those companies be more successful, I think it's like a really interesting model. So we've had to do a lot of stuff to make this model work. Like, we've built our own proprietary tech stack around. We have 2 people in our tech and product team that help us like do this at scale, because it's actually not easy to go and to pull in 50 different investors, get everyone and be able to compete with a venture fund who goes and does an LP call and they can get the capital in quickly. Like, we often can operate faster than them, even though the fact we're dealing with 50 stakeholders instead of 5. And so yeah, we've tried to productize it so that the model can work. And so yeah, we've invested in about 50 companies, about 100 million into those companies so far, and yeah, it's been an interesting journey.
Yeah, which is no easy feat as well. 100 million through a deal by deal structure within the time frame that you've done it as well is very, very impressive. I'm a huge, obviously biased advocate for syndicates through what we're doing at Playbook Ventures as well, and so can attest to, as you put it, the community based investing model. The value that's there from a deal by deal perspective as well. I guess, as you mentioned, it is a tough market at the moment, both from a founder's perspective, but also from an investor perspective as well, and trying to raise capital. And I remember when I was first pulling together the syndicate structure and speaking to a number of people, I think we might have had a conversation around that time period as well. But one of the things that someone mentioned was the challenges that kind of come from deal-by-deal syndicates or deal-by-deal investing is convincing investors to come in, the optionality of choice and them being able to choose in decisions. The other side of that is getting investors to see the value of that investment where that might not necessarily be in their sweet spot. I mean, we've experienced that with one of the breakout companies in our portfolio where trying to pull together capital for the first investment that we made in them was really tough. Now that everyone's seen how well they're doing, everyone wants to jump into follow-on investments, but obviously that becomes a little bit more challenging. How does 1013 think about that, especially with your broader remit of international investments and a very different approach that you take to investing as well? How do you think about that?
Yeah, I think there's what you'll find is, like with any business model, there's things that are positives and the things that are challenges or negatives that you have to work through and have workarounds on. So, look, I think it's relatively clear in terms of investor sentiment. It's in more challenging territory than it has been than it was, say, in 2021, 2022, where there was a hype cycle. There was a lot of invested capital going into venture capital. There were hot categories. There was exits. The IPO market was very wide open, SPACs, etc. And it's the age old saying of with Warren Buffett. It's like when everyone else is investing, you should be taking your money off the table, and the opposite is when everyone else is pulling back, you should be investing. And so I guess it's our job to convince investors that this is that these companies, we're getting arguably more favorable valuations and terms now, so it's more investor friendly, I guess you would say. And so it's actually more likely to be better vintages, better quality investments, if you believe that the category, generally as technology as a category, will continue in the same vein or same way that it has in the past. So from a typical investor, like the way we talk about it is like, hey, we should invest through the cycle. If we were happy to invest when it was more expensive, why wouldn't we be happy to invest now? The challenge that you have is that people are getting better. It's effectively, you can put your money into high yield private credit. You can put your money into even in the bank. And before, interest rates were so low that it didn't even make sense. Where now is, I guess you're taking a bunch of risk to go into more illiquid category, long-term hold. So there are effectively, it's up to us to educate and engage investors and explain to them why they should continue to invest during this period. And we've managed to do so. Like we've stayed completely active. We're doing 1 to 2 deals a month. And yeah, but it's fair to say that you definitely work harder in this model. Like you have to, I think of it as you do 2 different deals. You do a deal with the founders, like where you go and do all the due diligence, you do all like reviews of companies, and you agree to invest, and then you go and do a deal with your investors, and you have to share the light about why this company is interesting, why should they invest, and get them over the line. But we've done what we can to make the model to improve. We're always tweaking and always trying to improve to be able to engage folks and get those opportunities in front of them, educate and have a thriving kind of community that's also active and supporting, because it all feeds into the model of this whole network or community-based sort of investment model. But it doesn't necessarily by any means, there's challenges that you have to deal with. But I think the same goes for closed-end funds. There's, in that scenario, like the thing that I think is like really interesting is that if we truly believe in like collective thought, and it's interesting, so and as you say, not everyone is in agreement of what we're saying, and will obviously challenge us, but we get market feedback every time we launch a deal. It gets pulled apart by 500 plus investors of whether this is interesting or not. But in short, investors can make their own decisions, right? So they say, well, I don't like this one for these reasons, and you pass, or you can I guess back us generally, and we've got investors that do everything. Like we've got investors that we'll invest 10K minimum on every deal and build a portfolio, and we're trusting you guys to make decisions, versus folks that just cherry pick and go, I've got a wider portfolio, and I'm happy just to choose the ones that I like at different stages or different industries. And so, look, I think that flexibility is helpful, and people, but it's just a unique sort of background. But I think that we have continued on with it because we think it brings value across all those things that I mentioned before, like supporting founders, as well as on our side on deal sourcing and due diligence. And so we think all these things get into a melting pot and actually help us have an edge, which is different to the majority of other investors. And so, yeah, I guess that is one thing. And then yeah, like we have invested about, I would say 30+% of our invested capital is into international companies. That's probably higher than most in Australia because of ESVCLP, or the structure around most of the venture funds in Australia. They can't invest as aggressively internationally. And so we think that has been helpful. But at the same time, you have to bring a healthy dose of why are deals coming to you. If you're in another country, how do you find proprietary deal flow in a market? How do you do due diligence? All of these type of things you have to work around. And oftentimes it also comes back to, you've got to get into the arena. You don't know what you don't know. And oftentimes some of the learnings are done by actually making investments and just trying to understand and dipping your toe in the water. And it doesn't have to be big investments, but how do you've got to start, you have to have theories about where you think the world is going, what themes are going to make sense, where you want to spend your time and effort. And yeah, that takes time to develop. But at the end of the day, the hardest learnings you get are when you've actually got invested capital into businesses, and you actually get the insight into what goes right, what goes wrong, and that's true not only in Australia but across the different regions. But you do get pretty interesting feedback as soon as you're in the game, right?
Yeah, as you mentioned, I think every model has its pros and cons. I think with the deal-by-deal model, you're definitely having to fundraise every single time, so you're working hard on every single deal. But as you said, one of the advantages is more flexibility in terms of where you can invest that capital. As you referenced with the ESVCLP, it makes it a little bit more difficult to invest, or there are limitations on what amount of capital you're able to deploy into deals that aren't based in Australia, where you don't have that same limitation. We've been able to invest in some companies internationally as well, but not as many as you have. Yeah. When you are looking at investing into international deals, do you assess them in the same way in terms of the traction, the bar that you set for companies that you look for in the Australian market? Is that the same across different markets, or does that vary based on the particular market and opportunity that they're going after?
Yeah. Flexibility is a blessing and a curse. So effectively, just because you can doesn't mean you should. So what's interesting is, we can hypothetically invest in whatever we want from a stage, from a geography perspective. It doesn't necessarily mean that it's going to give us the best returns, etc. So we do change our review, particularly post learnings from different markets and stuff on how to actually invest in different markets. But look, I guess the age-old theory comes back. The key areas that you should look at: the founding team, their backgrounds, the opportunity ahead, why now, like all of these aspects hold true. And so why now is probably an example that oftentimes they say we've done some investing in emerging markets. That's a really important point. Whereas, not to say it's not as important in, say, like an Australian SaaS business, but if you're looking at, say, the rise of fintech in Africa, it's like, why is this going to be successful now? Is it the advent of more adoption of technology? There's more smartphones in Africa. There's a bunch of people that don't have access to bank accounts. So financial products will most likely have stronger adoption. They're almost skipping generations of infrastructure. So I guess there's a lot of different inputs that go in there, but a lot of the time also you have to go and do the work to understand why and unpack that, and then understand on the flip side of that what the challenges are. So challenges in a continent like Africa, and we've got a handful of investments over there, is capital raising risk. It's when the tide goes out in terms of the venture category, appetite for higher risk jurisdictions like that is like effectively they're the last ones in that where investors are interested and willing to invest. And there's macroeconomic challenges. There's still a high degree of political uncertainty in some of the countries. There's high inflation. So the challenges that you're like effectively macro risk, you can call it. So like you have to unpack those and understand what that means and how that impacts businesses. But again, we've learned lessons from our investing there you would never have learned. And so I actually had a call with another Australian investor that was looking at an African fintech, and I was like, these are the 5 areas that I'd dig into and try and understand straight away. And they were like, oh, well, we wouldn't have even really thought about 3 of these because we didn't have the sort of background and context. So over time, you learn, you build a knowledge base. But I think there's different things we definitely look at in different markets, but then we also try and pulse, and we take the same network-based thesis around due diligence, but on the ground there, you basically form relationships with other venture firms, other sort of angel investors, your founders within your portfolio, etc., and use them to give you a collective view of each new deal and opportunity. You definitely can't operate in a vacuum. The risks are generally higher in those in say like more sort of emerging markets. So it's been an interesting journey on that. And then the same thing goes, but also we've made a bunch of investments in companies based in San Francisco and things like that. So, but then that also goes to more questions of how did this land on our desk? Why is this a proprietary deal versus it's a thriving ecosystem there? There's a lot of capital. Like, why would they be talking to an Australian VC? What's the link? Why is there an opportunity that's opportunity for us? And is that you don't want to be the sort of sucker in the room because you're the last one they're sort of going to. And so we did a deal called Rockfish Data. It's a synthetic data business. Like the Carnegie Mellon is the top AI university in the US. The team is spun out of there, and they've got a really, really strong commercial CEO. But that CEO basically worked with one of our investors on the board of his last company and just said, hey, I'm looking to raise an angel pre-seed round. Did you want to invest personally? And he was like, oh, you want to talk to Ten13? I invest through them. And so he shared the deal onto us, and then we co-invested with a handful of other VCs in the Bay Area. But it's like those type of things. It hasn't just come to you cold, etc. There was a warm connection that made it an opportunity that you got an inside track from someone in our network and was helpful, right?
You would have heard me say many times on this podcast before that I am such a big believer in surrounding yourself with the right people. And that's why I'm delighted to partner with Sender. Sender is the OG startup accounting firm in Australia, catering to all stages of your business life. If you're busy running your startup, you don't always have the time to balance your own books or do forecasts, and instead you can fully outsource your finance function to give you the time, energy, and resources that you need back to do what you do best, which is growing your business. They have a dedicated focus on founders, funders, and startups, and have an experienced team that can help you with everything from managing your tax to balancing your books to even helping with your exit strategy. I trust and use them with all of my businesses and can't recommend them highly enough. To find out more or to speak to Gareth and the team, head over to sender.com. That's SCENDAR.com. All right, let's get back to this episode. And obviously, making investments is part of the part of the work. The other part is actually supporting and working with those portfolio companies as well. I spoke to Brendan Hill, who mentioned that just last week he's said you spent roughly 20 hours working with a company on their bridging round and helping them with financial models. And that's often a part of the job that gets overlooked and less understood. And to my understanding, you have 50-ish sort of portfolio companies in 1013, 80 all up, including transition level investments.
Yeah.
How do you juggle and balance your time between obviously continuing to source new deals, onboarding investors, but then also continuing to support portfolio companies? And what does that structure look like internally at 1013?
Yeah. I mean, we have a small team. We have 4 people on the deal team that are in charge of deal sourcing, deal execution, and supporting like portfolio support. And then we generally look to run events and other things. We have a founders conference every year where all the founders all get together, etc. So we generally have a lead and then a secondary person linked to every company. We try and do things like, we call it strong start, where it's, as soon as you make an investment, how do you engage well? How do you set a framework, infrastructure around that, whether that's recurring meetings and what a good reporting stack would look like. We've got partnership programs with a whole bunch of service providers for discounts for those folks. We've got a bunch of growth notes, and we share our radar sort of scenario, which is effectively all the underlying investors that invested in those founders and where they want to start connecting with them. So we try and do a bunch of things to support on the portfolio side. But look, at the end of the day, what tends to happen anyway, in my experience, is like, each company is different. It's different stage, different sort of needs. It's who's best placed to help them, where are they at in their journey, and who else is around the table that's also supporting. Oftentimes it's other venture firms or angel investors or advisors. And so inevitably what tends to happen is some companies you're like talking to every single day. Some companies you're talking to once a month, and effectively we do have a wide portfolio, so it's hard to say I'm not gonna be able to commit 20 hours a month to every one of the companies. Clearly, you only have so many hours in the day, but that particular company we've got a strong investment in. We're helping them pull together all the material for a seed extension round. They're talking to a handful of investors, and we're helping coach them and guide them on the journey to make sure we get a good outcome and get the right doors open to the right investors, but also have the right material. It just depends on the deal, right? Or not the deal, the company and the stage they're at and what help they need. But yeah, at the end of the day, you don't want to be you want to be positive impact on the companies that you're supporting, and it goes in tiers. It's VCs can be both positive impact as well as giving you capital. Some can be passive on capital, you give you capital but not much impact. And then there's some that are give you capital but also headaches. And you never want to sit in that last category. It's effectively reputation is everything in our world. You want the founders that you're working with to have a good experience, and you do your best to help them navigate through the pathway of building a successful business, right? And so yeah, it just depends. Our world is it's relatively unstructured because of the nature, so it's hard to fit everyone in a box. I mean, I've learned this over the years. I just don't think you can. So what works for some founders is basically just, hey, I just love you to be online on WhatsApp, and I can just ping you like, hey, do you have a connection to this person, or can you help me with this? Very brief interactions and keep it informal. And others are like, hey, our preference is like, we give you a report monthly, we catch up, and then go through the 3 strategic items that we need coverage on and get that sorted. So yeah, it depends by each business, but we've tried to put in place structures and arguably pillars of how we support and how we want to be viewed and how and where you can add value. But at the end of the day, we also have a view that we're by no means the only people that can give solid advice and support these companies. So how do you we'll get the right people in the seat, that even if it's people from our network that could be more helpful than us to support for their next phase and things like that. So you have to be relatively self-aware and just try and figure out what's best, right?
Yeah. And so speaking of that, it's my understanding you supported the merger of Mr. Yum and me&u, which is something we spoke about with Adrian, who's one of the co-founders, recently on the podcast. Do you want to maybe share a little bit about that story from your perspective?
Yeah, so Mr. Yum was a at-table ordering product. They're headquartered in Melbourne. We led their seed round, and I joined the board, and then we led their post-seed round, and Airtree joined. And then they did one of Australia's largest Series A rounds. They launched into the US and the UK markets and grew really fast. And then that was 2022. Then obviously they had a lot of capital in the bank, but also the whole sort of they're dealing in a consumer spend environment, and that's been more challenging to sort of navigate. So venues are having a harder time. So they were like, what are strategic decisions that we can make in our business? And they found that they were coming head to head with me&u basically on every large tender or opportunity, but not only in Australia, like weirdly. So there's what we found over the years was that the two best companies in the category were basically Australia based, which was Mr. Yum and me&u. They were fierce competitors in Australia. Both had won great sort of large venue sets. They would always be competing with each other, not only in the Australian market, but then I found it was in the UK, it was like the name keeps coming up as me&u. And then even in the US, they were both based in Texas. And it's like, it was just interesting that it was like, hey, we're butting our heads and using firepower or capital in a very similar space and product and go to market in almost the exact same locations. Like it seems like inevitable that these businesses would be better collectively, would be better together. And so, look, that's always easy to say, but hard to execute when you've got basically two founding groups or founder on both sides that I think they're like that's their almost like public enemy number one. Like you're competing on every deal against them. You're almost like energizing your team of, hey, we got to win this deal against me&u or whatever. So how do you bridge that gap? And a lot of the challenges with getting a deal done is not only getting founders to put their swords down, but then also and think logically, but also then the cultures of these two organizations. It's a big risk of bringing them together. They were actually run quite differently in terms of their culture and style. And so it was like, even though despite their sort of technology being similar, they were on different tech stacks. So there was a lot of components to it. But the main thing is, how do you keep a cool head around? And there were so many occasions where it was over the course of a year we were trying to get a deal done on negotiating terms and coming back to the table and then cooling off, like not sure if we should do it, and coaching and working with the founders of does it still make sense? How do we get to an agreement? And so it was just a journey, right? But at the end of the day, I think it's a positive result that they managed to get the deal done together. They've managed to combine forces and take what's good in terms of operating systems and teams from both businesses, and are now, I guess, arguably a healthier and more disciplined and better opportunity set business off the back of it. So, and I think it's hard to make decisions until you have all the information, but it's also trying to make sure you don't let I think it's just like, how do you manage those relationships and make sure that it's not us versus them, and how do you effectively it definitely is this type of deal when you've basically got the two biggest competitors that generally been up against each other. That's always going to be a hard fought deal to see what's the merger ratio, whose tech stack, whose name brand do we take, like all of these sort of decisions. It's not an easy thing to navigate. And so, but Kim, Tio and Adrian, they're also partners in life, so that they're an amazing couple, and Kerry, who's also one of the co-founders. But yeah, like those folks have done exceptionally well navigating through that. It's not an easy thing to do for founders, but yeah, they've managed to do so, and then now they're leading the business going forward. So the both boards decided that they would hand over the reins to them as the founders of the overarching sort of entity. And yeah, it's been great to see like this sort of what they've been able to build and continue to build off the back of that. And so I was on the board all the way up until the merger, and we wanted to keep it tight, so I stepped off the board, but I'm a board observer. But yeah, it's a great journey, sort of seeing them on the trajectory. And yeah, we're strongly invested in me&u as a business, and so want to help them succeed, and so it's good to see them get a good result there.
Amazing. And maybe final question, mindful of time, Stu. Yeah. Final question is, as you said, you're industry agnostic as well, and as you said, the downside of having options is that you have to be able to draw a line somewhere. What what are areas that you're excited about, or what are you seeing in the market at the moment that's exciting you and exciting your investors?
Yeah. Like, I think an area that I'm quite excited about is the advent of AI in healthcare, and even just healthcare as a category and with longevity included. I think that there's going to be material changes in all areas of healthcare. There traditionally has been a tough nut to crack from a sales perspective and actually engagement from a software perspective. But then in addition to that, in clinical nature, whether it's on clinical trials or all the way through to healthcare delivery, I think there's going to be new models. I think AI is going to help us push drugs through faster, get better results from those, get those to market. I think this is going to be a lot of movement over time around this category, and it's probably one of the last cabs off the rank that I think where there's going to be major sort of venture opportunity. It's obviously one of the biggest core markets globally, but I'd say traditionally it's not been one that's been easy for startups to engage in and disrupt, I guess you'd say, and for the better, to get better service delivery models, etc. So we've made investments across the board in this category. More recently, I think we co-invested in one called Everlab, which is all around longevity and making sure you stay healthy for longer. And it's like a new age kind of GP and health system where effectively you can over time be much more data driven about tracking your own health and picking up any potential problems way before, so preventative healthcare. And then we've also made other investments, a company called like Arintra, which is helping doing like revenue coding within the healthcare system using AI models, mainly in the US market. And a few others. We're looking at one now, which is an AI business that's helping with clinical trials, like reducing the time taken for clinical trials and drug discovery to go through the process. So a really interesting space, and I think there's going to be a lot more activity. So looking forward to seeing how that plays out.
Amazing. Stu, as I mentioned, I've got a ton of notes and could talk to you for hours, but mindful that you've got another meeting to head to as well. So appreciate you coming on. For anyone that wants to find out more, say hello, get in touch, what's the best way for them to do that?
Yeah, so if you're a founder, look, our door's open. We want to talk to you. We want to see what folks are building. So you can reach me on at LinkedIn, on Twitter at Stew Glynn, or on 1013. If you want to email us, you can email us on investments@ten13 VC. But yeah, I'd love to. Like, the door's open. We're keen to engage with founders, and we're always looking for other investors that are keen to support. So if you are interested in technology as a category and are sophisticated investors in Australia or New Zealand, then welcome you to come on our 1013. It's Ten13.VC, and you can see more material there. But yeah, we're effectively trying to build a large community that can help more founders be successful and go on to build awesome stuff.
Amazing. I will make sure all of those links are in the show notes. Stu, once again, thanks so much for coming on the podcast. It's been awesome.
Thank you, Rohit. Awesome, mate.
Thanks for listening to episode 191 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.